All right, the biggest drop of the year on Friday, but we're bouncing back a little bit in terms of futures. 30 minutes to go until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, stocks attempt to come back after the S&P 500's worst session of the year on Friday. Investors shaking off tariff fatigue and bracing for NVIDIA's pivot earnings.
As we await NVIDIA on Wednesday, Apple announces plans to invest $500 billion in the U.S. over the next 4 years. Meanwhile, Microsoft has reportedly started canceling leases for its AI data centers, raising concerns about demand.
And Warren Buffett is still sitting on a huge pile of cash. His Berkshire Hathaway hoard grew to a record $334 billion in the fourth quarter as operating earnings surged 71%. All of that and more coming up. But let's take a look at where markets are trading after that wipeout that we saw on Friday. Like Matt said, of course, coming back a little bit, trying to claw out of that hole, but a long way to go when you consider that the S&P 500 fell by about 1.7% on Friday. We had weak sentiment data. There's concerns about what's going on when it comes to that other bat virus that's brewing. You take a look at the S&P 500 right now, though, higher by about 0.5%. Similar story if you take a look at the NASDAQ 100 with your big tech index, also higher by about 0.5%. The bond market is an interesting one. We are coming off of 6 straight weeks of falling yields, but we've been around these levels for a while, sort of glued to that range that we've been trading in. And right now, Matt Miller, the bond market pretty much unchanged on the 10-year.
Yeah, but I think it's fascinating that we're down 6 weeks in a row on the 10-year yield. We haven't seen a run like that since 2019. In terms of stocks, you know, we did hit an all-time high last week, but when you look at what that's been driven by, it's a little bit concerning. Here's a year-to-date look at the S&P 500 broken down by sectors. Consumer staples, the biggest winner. Healthcare, the second biggest winner. Utilities, the third biggest winner. These are incredibly defensive sectors, so to be driven higher by investors rotating into a defensive position is not really causing anyone to sort of buy new hats.
It's kind of a bummer, too. If you look at what's gaining in those consumer staples, it's some companies that have been doing very poorly the last couple of years. So valuation is everything in this market. Matt Miller, let's look at the values right now of some of the biggest stocks in the market. We're looking at NVIDIA up about 1.9% pre-market. We are looking at shares climbing ahead of the big day, earnings on Wednesday. The report will likely determine the direction of markets on Thursday, and investors, of course, are keeping a close eye on supply and demand for its Blackwell chips in particular. Microsoft now on the rise. This is interesting. They were fluctuating this morning. There's some analysis out there that Microsoft is canceling leases for its data centers in the United States, according to analysis by TD Cowen. The company reiterated its AI spending target of $80 billion for the year. However, Apple, though, down 0.5%. This comes after news that Apple will invest $500 billion over 4 years to expand its infrastructure in the United States. The company will add 20,000 employees in the process, and that's all as it grapples with threats from the Trump administration in terms of tariffs, particularly as it pertains to China, Matt.
Yeah, I mean, everyone's grappling with those kind of threats, and the Trump administration is really moving on China. We already have actual tariffs there under the International Emergency Economic Powers Act. Plus, we have Donald Trump, I guess, trying to convince Mexico to put its own tariffs on, and you have him asking CFIUS to cut China spending as well. So really a triumvirate of attacks on the China front.
Yeah, especially when it comes to tariffs. I mean, it feels like traders are trying to suss out what is signal, what is noise, what is a negotiation tactic, what is actually going to turn into policy. Let's talk about the stock market, though. I mean, it was really interesting to see these losses just accelerate into the close on Friday. And, you know, we've seen some delayed reactions to data. It felt like a little bit of a delayed reaction when you go back to the sentiment data that we got at the top of the 10 a.m. hour on Friday. Long-term inflation expectations, the 5 to 10 year outlook, 3.5%. That's the highest since 1995.
And what I think is fascinating is that even though inflation expectations are high, yields were driven lower. And this really shows you how worried people are starting to get about the economy. People are looking at that consumer, how much it could drive the market. Made you guys a chart of the Magnificent Seven, which is down on the year, versus the 10-year yield. And you could see the differential. Over the beginning of last year, it was quite large. Yields went down, the Mag 7 went up. And this is no longer true. And I think that is a fundamental truth that this market is going to have to now grapple with.
Well, I think it's, of course, sort of the same story, because you think about traders being reluctant to hold risk into the weekend. They're buying safety in bonds. So bonds taking on that haven role as we question big tech. Let's cover all the tech news with Bloomberg Intelligence senior analyst Mandeep Singh joining us now. And Mandeep, I want to start with Microsoft and a very curious note from TD Cowen saying that Microsoft has started to cancel some leases for U.S. data center capacity. We've been having some lingering questions about AI spend since DeepSeek sort of broke the internet a couple weeks ago. What do you make of this? What should we take into this heading into NVIDIA earnings?
Well, right now, I think all the mega cap companies, especially here in the U.S., are focused on building data center capacity in the U.S. We saw the Apple announcement. So what it shows is there is a pressure from the administration to really double down here in the U.S. So, I mean, look, all these companies are international. So as part of their CapEx plans, they have plans to add capacity outside the U.S. I think they will pare back in terms of, focusing here in the U.S. And then with the DeepSeek, as you mentioned, look, everyone is focused on how much you can scale up training. And there have been doubts created after the DeepSeek movement. So a company like Microsoft can say, OK, we want to focus more on inferencing. And that's where, wherever we can add data center for inferencing, that's what we'll prioritize for now. So I think those are the two drivers, if you ask me, when it comes to Microsoft's plans.
I think I'm also very interested in the Apple news and the initial market reaction around it. It's not the first time we saw companies try to rearrange their businesses around tariff threats, is it?
Yeah, look, I think with a company like Apple that generates over $100 billion in free cash flow, if their CapEx budget is $10 billion, whereas a Microsoft and a Google are spending above their free cash flow generation of 70 to 75 billion, it makes you wonder, why is Apple not spending? And in this case, I think administration wants all these large tech companies to spend here in the United States. I mean, Apple, with their free cash flow, is a no-brainer. So I think, and they can spend on two areas. One is the server side. The other is the chip manufacturing. I think they're going to prioritize the buildup of data centers right now, given all the emphasis on AI.
We'll see also how much they're actually rearranging.
Right.
It sounds more like just a rebranding of plans that they already had in place.
America first.
Mandeep, thanks so much for joining us. Mandeep Singh there from Bloomberg Intelligence. Want to broaden out the conversation right now with Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Manager Solution. Jack, we see this Apple headline, right? They're going to invest $500 billion in the U.S. over the next 5 years, all thanks to Donald Trump. But the last time they came out with the 5-year plan, it was 430, and so it's only a 16% increase. They've hired 20,000 people over the last 5 years. Now they say they're going to hire 20,000 people over the next 5 years, all thanks to Donald Trump. But this is just business as usual with a different slant, right?
Yeah, 100% agree, and I think this is really just more of the same. I think the read-through that the market's trying to get is that, are we really starting to see a significant cutback here? And, I'm sure when we hear the NVIDIA conference call on Wednesday, we'll get some confirmation of how that's shaping up. But I think the bigger picture here is simply a shift that should be playing itself out with AI, right? We're going to move away from these data centers and probably move more towards inferencing. And that's basically what Mandeep just walked through there. You're going to see the evolution of the AI trade, and it's going to continue to shift.
Let's talk a little bit about NVIDIA and how high the stakes are right now, if you want to say that, Jack, because we've been joking the past couple of quarters. It really feels like NVIDIA earnings have become a macro event. People are talking about it in the same importance as a Fed meeting, for example, an inflation report. How are you thinking about NVIDIA this time around and how much it matters for market sentiment at this juncture?
I still think it does matter, maybe not quite as much as it has been. We've seen a little bit of the steam coming out of the Mag 7 more recently. And I think the focus has been shifting a little bit more to geopolitical concerns in here. So, when you start to think about the sentiment that we've been sort of going through with regard to either corporate sentiment or confidence, business sentiment, business confidence, that's sort of been wavering more recently. And so you start to get some weak economic numbers here. And not surprising, that's what we got on Friday. You get a sharp sell-off. So I think at the margin, these Mag 7 earnings will help. NVIDIA will help. But I think the focus is shifting a little bit more to these geopolitical headlines that continue to come out of D.C.
There certainly seems to be some jitters under the surface. Jack, I want to point back to some comments we heard last week from Steve Cohen over at Point72, speaking at the FAI conference. He was talking about a period where he believes the best gains have been had, and it wouldn't surprise him to see a correction. Do you agree with that?
I think we're turning a little bit more cautious in here. And one of the themes that we talked about at the beginning of the year with our clients was, one, maybe the outlook for growth was a little bit too sanguine. And two, maybe the market was a little bit too hawkish on the inflation outlook. If you sort of fall back on that growth backdrop, you look at what's going on in the labor market, and we continue to see that cool. And the problem that we're running into there, look at consumption. It's running above disposable income right now. That cannot persist. So we would certainly expect to see that slow on the back of slowing labor market backdrop. Consumption probably continues to slow, and that's just one of the pieces that we continue to point to. But at the end of the day here, we certainly expect the economy to slow, and I think that's the biggest risk in here. A slowing economy against sentiment that may be waffling, that probably sets up for a potential for a correction in here.
We're not going to see, a lot of people are telling us, Jack, any expansion in PEs, for example. So we have to see earnings increase to drive the stock market higher. And we're already we've already got a pretty high bar there, right? I mean, analysts have lowered it into the beginning of the year, but we're still looking at double-digit percentage gains for S&P 500 earnings this year. What are you looking at, and are we going to continue to see that come down?
Again, I'd like to say that we're simply slowing, but keep in mind we're slowing from a pretty elevated pace. And from our backdrop, we're looking at something closer to a 4% nominal GDP growth backdrop. And if you look at periods in history of 4% nominal GDP growth, that basically equates to a 9% earnings per share growth. So, looking at a 9% earnings growth, maybe a little bit of a dividend increase there. It's not hard to get to a high single, low double-digit return on equities. But listen, we're going to get a correction along the way. We haven't had one in a while. It's going to feel bad. But the combination right now is, I think, setting up for that sort of correction. But if we do get that, certainly we look at it as a buying opportunity in here.
Yeah, and you've certainly heard a lot of folks sort of warning about that correction, including on this program. Jack, unfortunately, we have to leave it there. Always great to speak with you. That is Natixis lead portfolio strategist, Jack Janasiewicz. Let's take a look at some of the other movers ahead of the opening bell, less than 20 minutes away. You can see Palantir. It's bad day. It's bad news narrative just gets worse. Down another 4% today after falling 15% last week. Those Pentagon budget concerns really weighing on this stock. Domino's is an interesting one as well. Its sales fell short with consumers pulling back on spending, but it was really a U.S. story because international sales actually pretty strong. And then you take a look at Bridge, currently higher in the pre-market. That's because Apollo is going to buy Bridge for $1.5 billion in its real estate expansion. Apollo shares also mildly higher right now, which is interesting because typically the acquirer falls. Not in this situation, though.
Yeah, that's pretty fascinating that Apollo's doing that kind of expansion at such a big premium, right? 35% gain for Bridge shares.
It's actually the market cap of $1.5 billion in value here. All stock transaction is actually more than 50% higher than where this company was trading on Friday after 3 straight years of decline. So,
all right, we will discuss that very soon. A lot to get to here. And coming up, Berkshire Hathaway's operating earnings surged 71% in the fourth quarter. We'll take a look at what's driving the move next. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Tesla is preparing to deploy a software update for its Chinese customers to bring self-driving capabilities, or at least so-called self-driving capabilities. A lot of argument as whether that really is autonomous to the market. Bloomberg sources say the update is planned for the coming days and will allow Tesla owners to use driver assist features on city streets. The car maker was facing challenges with full self-driving in China because both Beijing and Washington place limits on how Tesla trains its systems to handle local roads. So there you go, more than you ever wanted to know about Tesla's offerings in China. Starbucks is eliminating over 1,000 corporate jobs, or 7% of its workforce, in a bid to improve efficiency. The coffee chain is also closing hundreds of open and unfilled positions as part of its restructuring. The job cuts do not affect workers in cafes or in manufacturing and roasting operations. Workers who are losing their jobs will be notified by tomorrow. So we're giving you a little bit of a heads up here. JP Morgan is increasing its direct lending effort. The big bank is setting aside an extra $50 billion to capture a bigger chunk of the fast-growing market. The fresh commitment comes after the bank deployed over $10 billion in private credit deals since 2021. JP Morgan's expanded effort underscores how banks are staking their claim in the $1.6 trillion market that had previously been the domain of asset managers and credit shops. This sounds like something we would talk about in our Wall Street beat. Actually.
I know, we have more even to talk about there in the world of private capital, but certainly $50 billion is a lot of money.
Yeah.
JP Morgan tells Bloomberg that it's a comfortable number, a totally comfortable number for them to commit to. But we're going to switch gears. We're going to talk about the Oracle of Omaha this morning because Berkshire Hathaway reports a 71% boost in operating earnings. The jump is fueled by an increased insurance investment income. Buffett, though, also saw his cash hoard grow to a record $334 billion, and many are anticipating his next big deal. For more, we're joined by Matthew Palazzola, Bloomberg Intelligence property and casualty insurance analyst. Okay, 10 straight quarters in a row of their cash hoard expanding. At $334 billion, what does that say to you right now?
So first off, great problem to have, right, for Buffett. They just don't see a lot of opportunities. They don't see their stock as undervalued, so there has not been a lot of share repurchase. They've sold a lot of stock in 2024, so that was contributing to the cash going up, and they've been generating a lot of cash.
So it's like you say, this is a good problem to have. Champagne problems to an extreme degree. Should we stop holding our breaths, waiting for a deal here? Someone on Markets Live, Ben Ram, I believe, points out that at this point, Berkshire Hathaway has enough cash on hand to buy Coca-Cola outright.
Yeah, I mean, I don't see anything that seems attractive to them in a space that they know, but you never know. Then they might find something that's boring and has a monopoly somewhere that they, really find interesting. But I've kind of given up on, a big deal coming around the corner.
What does Warren Buffett think about share buybacks? It's a hot political topic in this country right now. The Democrats, Elizabeth Warren, firmly against this kind of thing. But if you can't find anything else to do with your money, why not return it to shareholders? Yeah,
so he loves when companies that he owns buy back shares because that increases his proportional ownership of the company, right? But they never bought back a ton of Berkshire stock, and they only started a couple of years ago, and they've kind of slowed down. So I would think, in general, Buffett is vastly in favor of share buybacks, but he's very cautious when doing it with his own stock.
Well, speaking of his own stock, you do have Berkshire not only outperforming the S&P 500 since you look back to 2019, they haven't had a down year since 2015. That's 9 years in a row. How do people feel about Berkshire right now? You mentioned expertise. There's succession questions. Insurance has kind of just come back for them, and they've been missing out on a lot of the market gains when you look at their own investment portfolio, haven't they?
Yeah. Last year, they didn't really dramatically outperform the market. It's kind of been floating around. I think the operating businesses' earnings into next year have to go down, really, especially in the insurance business. In the fourth quarter in 2024, they saw a lot of kind of one-time or odd items in the insurance business that really pushed it ahead. So it's like going forward, the earnings outlook looks, not great. But their stock is still kind of hovering around all-time highs.
All right, Matt, it's always great to see you. Talking to you about something that's not a natural disaster,
Something
which
on
is
fire, blowing up.
nice change of pace. That is Bloomberg Intelligence's Matt Palazzola. And it's interesting to talk about Berkshire. I mean, we've all been waiting and waiting for a deal. We'll have to maybe take down our expectations there. But you do see a lot of folks trying to mimic the Berkshire Hathaway model. I mean, we talk to Elias Sabo over at Coty often, but also Bill Ackman. Yeah, exactly. But Bill Ackman trying to sort of be a mini Berkshire as well with this proposed takeover of Howard Hughes.
I think it's really fascinating because you have seen kind of an influx of baby Berkshires, if you will. You have KKR not being shy about kind of modeling the business plan, Apollo in a big way. With that kind of competition from private equity, there's a big argument out there that Berkshire has now gotten itself into potential bidding wars.
I don't know. With $334 billion of cash, that's quite a
I don't want to get in a bidding war against them.
No.
You know what's interesting? We used to always, Bloomberg News used to always put the age of the subject in the top of the story.
Are you
so
going
you'd
to
see
tell
Warren
us?
Buffett, and then it would say he's 94. You know, which I thought was interesting and important information.
Yeah.
I noticed in the German election story yesterday, they didn't even say how old Friedrich Merz was.
All right. Well, you should write a letter to the editor.
They need to bring it back.
Listen,
Bring it back.
But back
He's
to
69,
Berkshire,
by the way.
real quick, though, they tend to buy when things get really bad. So if we do see that correction, that's kind of when I would expect them
That
to
is the smartest. You think he read Benjamin Graham?
You know how many
The
people are
Intelligent
throwing
Investor?
that book out the door? But yeah, exactly.
All right, one of the biggest shareholders in Bank America is Berkshire Hathaway, and tomorrow on Bloomberg, David Rubenstein is going to sit down with the CEO of Bank America, Brian Moynihan. That starts at 8:30 a.m. New York time, an interview you don't want to miss. This is Bloomberg.
Welcome back to Open Interest, a check on futures as we count down to the opening bell. You can see a bid coming back into the market after that brutal session that we saw on Friday. The S&P 500 higher by about 0.4%. Similar story if you take a look at the NASDAQ 100. Small caps leading the way, at least for right now, with the Russell 2000 up about 0.6%. You do have the likes of Mike Wilson from Morgan Stanley saying that this dip that we're seeing, it's going to be bought. You have the U.S. with the highest quality index, the best earnings growth prospects. He doesn't expect it to last all too long, but who knows? We've been hearing a lot of correction talk over the past couple weeks, so we'll have to see. But coming up, less than 4 minutes until the opening bell, we'll discuss all of that with Rebecca Patterson next. This is Bloomberg.
We are moments away from the start of trading. Looking to get a little bit of a rebound today from the big drop on Friday. This is Bloomberg Open Interest. I'm Matt Miller. Here you can see futures are higher. It's only 0.33% on S&P futures and NASDAQ futures. Russell 2000 futures up a little bit more. And we did have the biggest drop of the year so far on Friday after worries of the consumer and possibly a new COVID spooked investors. They're not as freaked out today. You hear the opening bell on the New York Stock Exchange. I've been waiting to see. This guy, his name is Hunter Westbrook, which is like the preppiest name I think I've ever heard. He's the CEO of HTB. They didn't look extremely preppy. Down on the NASDAQ, Power Solutions International, P6. This stock is up 1,377% over the last 12 months. They are absolutely killing it. So a good day to ring the opening bell for them. In terms of the major averages, we are seeing a little bit of recovery. Don't forget, we did have an all-time high last week, so a little bit of profit taking not to be unexpected. Katie, what do we see right now in the live indexes?
Matt Miller, we had 2 all-time highs last week. Of course, it was hard to remember that specific fact when we were watching stocks really fall out of bed into the close on Friday. Like you said, a little bit of a bounce back here, people trying to maybe buy the dip a little bit, but we certainly have a long hole still to climb out of. The S&P 500 higher by about 0.4%. Big tech, similar story, up about 0.3% as we await NVIDIA earnings, which we'll get to in a second. The Russell 2000, this was your leader pre-market, but sort of giving up the lead right now, higher by about 0.2% on the Russell 2000. This was also your biggest loser on Friday, so we'll see how this leaderboard shuffles around. But let's talk about NVIDIA climbing a little bit as Wall Street eagerly awaits earnings after the bell on Wednesday. Investors closely watching sales growth and supply for its Blackwell chips, as well as anything Jensen Huang has to say about DeepSeek, which, remember, triggered NVIDIA's biggest single-day loss back in January, but shares currently higher by about 2.5%, Sonali.
I'm also looking over here, Katie, at big tech and spending plans. Microsoft flat this morning, essentially. It is pulling back on its data center growth. The company is canceling leases, according to analysis from TD Cowen, and it's raising questions about the outlook for demand. Interesting to see NVIDIA shake off those worries, though. Apple now up. It has been fluctuating into the market open. Will be interesting to see where it ends the day. It is boosting its bet on the U.S. It's planning to spend $500 billion over 4 years to build out its data center and manufacturing presence in the States. Matt, I hear they're going to be building training facilities in Michigan as one part of that, too.
Training facilities. That's awesome. It's a golden age. We've entered a new golden age, Nolly. I think, well, we'll get into it, but Apple, if you look at really the 5-year plan, it's only increased spending 16%, and they're going to hire the same amount of people in the next 5 years they did in the last 5 years. But we're going to talk about this. Mark Gurman is actually going to join us later on in the show. He is a scoop machine when it comes to Apple, and he knows the lowdown. Take a look at the S&P 500. This is the last 3 days, so you can barely see today, but it comes off of the highest level that we've ever seen for the S&P 500, 6,144. So, yes, we had a drop on Friday. Wasn't one of the top 10 drops that we've seen in this bull market, I know from the Data Trek note this morning. But it was the worst we've seen year to date.
Yeah, which is saying something. Biggest downward move since December 18th, I believe. But remember that great story that we were talking about with Jess Menton a couple of weeks ago, that so far in 2025, it's been Fridays and Mondays that have been the worst session. And it really speaks to this nervousness, I think, is in the market. Maybe you're not seeing it in the VIX, but traders just really don't want to hold risk into the weekend. They're happy to just dump on Friday and then maybe buy back as the week progresses. And
I think some of the problematic part of that, too, is the decoupling you're having from the interest rate story to the stock-specific story. There are different catalysts, and I think you can blame the quants a little bit here when it comes to the Friday moves.
I don't know if there's a decoupling, though. I think people are buying bonds 6 weeks straight because they're worried.
Yeah, well, that's the question.
But you're not seeing the indexes rise on the heels of that either. That's the bigger problem.
Well, I think everyone is worried, which is maybe why. But let's ask.
You don't buy the indexes if you're worried.
Yeah.
Right, exactly.
Yeah.
The reason the bonds are showing a bid is the same reason you're not seeing stocks rally off the heels of lower rates.
Yeah, so that story working together nicely. Let's unpack it all with former Bridgewater Chief Investment Strategist Rebecca Patterson joining us now. She also now serves as Senior Fellow at the Council on Foreign Relations. Rebecca, great to see you.
Good to see you
person.
all too. Thanks.
So let's actually start there. I mean, this relationship that you're seeing between the bond market and the stock market, it feels like for so long they weren't necessarily talking together, that bonds weren't acting as that haven asset class to equities. But you think about yields on the 10-year falling for 6 weeks straight. You think about this jitteriness that you're seeing at the equity index level. Are we seeing that diversification benefit come back to bonds?
I think we are seeing that diversification benefit come back to bonds. And one of the correlations, and I'm always careful about causation, but one of the correlations we've been seeing over the last few months is the economic surprise indicator. So U.S. economic data, is it better or worse than what's expected? It's been getting worse. So economists all got very giddy after Trump's election, thinking we're going to have deregulation, tax cuts, golden age, Matt.
Oh, yeah.
And what we're seeing instead is just more uncertainty, and that's starting to show up in data. So we've seen that surprise indicator actually go negative. And with that, you are seeing bonds quickly follow. So again, it's correlation. I want to be careful. That's not the only thing causing this, but I think that's what we're seeing. It's worries that we're going to have slower growth than what had been expected. And again, it's early days. We still could get tax cuts. We could still see benefits of deregulation.
But you know what? It doesn't seem as likely that we're going to get all the tax cuts promised, that we're going to get a lift on the SALT cap, that we're going to get no tax on tips, no tax on auto loan interest. I mean, we are getting tariffs. The China tariffs have already come through, steel and aluminum kicking in.
We're getting a lot of tariff threats.
Well, China tariffs are on since February 4th. They have been enacted. Right? And you've got the sort of costs and chaos, as Jim Farley puts it. So And we're getting deportation. So we're getting all those inflationary things as they, axe federal government jobs and spending. If they don't come through with the tax cuts now, that's a real problem for Wall Street, isn't it?
Right, and it probably is part of why President Trump is pushing so hard to have one beautiful bill sooner rather than later to get that positive news into the market, to get that win, because it would be good for the economy, good for his party. But I don't know how quickly, reasonably, they can do that. We're seeing all the difficulties they're having within Congress right now, trying to move ahead on, is it one bill, is it two bills, how quickly does it happen? But to your point, what we're seeing right now is kind of the worst case scenario. We're getting uncertainty about policy coming through in surveys, and that is, and earnings guidance from Walmart and others, starting to weigh on growth expectations while inflation expectations are inching higher. And we saw that in University of Michigan last week, long-term expectations up to 3.5%. So if we get bond yields lower, that's what Scott Bessent, our Treasury Secretary, wants, but he's getting it because growth worries are increasing. That is not what anyone in the White House wants right now. You want lower yields because of lower oil costs, because of structural reform that increases supply side of the economy. And that remains to be seen.
Yeah, he might get what he wants, but for the wrong reasons. As much as I could stick on just that topic all day long, I want to switch gears a little bit, given that NVIDIA results are on Wednesday. I want to pull up the components of the Magnificent Seven, an index that has been down on the year, not a true index, but the Bloomberg index of it as well. Meta, you can see, is really the only significant gainer in that group. NVIDIA is up, but nowhere near what you saw a year ago. Tesla is a huge drag. When you think about how much this set of stocks has meant for broader market recovery, what does it mean that they're performing that poorly?
Well, I mean, we saw huge gains in these stocks in recent years. I mean, extraordinary gains. We know that these stocks have very strong free cash flow. We know that they still have strong earnings growth, especially for their size. The challenge is that everyone owns them. I'm speaking figuratively, but it feels like everyone owns them. And they have high valuations. Nothing like the 1999 valuations that we saw in that bubble, but still higher than the rest of the market. So they're vulnerable. So if you have disappointments, you have news like Microsoft's or news like DeepSeek, it's very easy for these stocks to see some profit taking. I think longer term, it's still a place I want to be, more neutral than overweight. And honestly, if the U.S. economy slows and we have, okay, what companies are going to have structural supports in a slowing growth environment? Tech is one of the answers. So I'm not giving up on tech yet, but I do think the fall in tech that we've seen recently is part of the reason you're seeing investors looking around the world. Is there somewhere else I can hide?
Right.
And that might be one of the factors helping places like Germany year to date.
And Rebecca, I think that's interesting and important that people are looking elsewhere, because you think about the NASDAQ 100 falling 2% on Friday. You take a look at the gains that we're seeing right now. Now we're just 0.1% higher on the NASDAQ 100. If we were in 2020, 2021, people would take a look at what happened Friday and say, stocks are on sale. Let me barrel in here. But it feels like that buy the dip impulse is maybe fading a little bit.
I think we're now in a show me environment. Show me on earnings, show me on projections, forward looking, right? NVIDIA will be really important for what does Huang see going forward. If that picture is bright relative to expectations, you're going to see all of the Magnificent Seven benefit. But if there's a note of caution, whether it's the policy environment, DeepSeek, anything else, these stocks could still take a bit of a hit in the near term. Again, though, if we're in a slowing growth environment, not a recession, but just a moderation in growth here in the U.S., large caps tend to do relatively better than small caps, and stocks that have strong free cash flow tend to benefit, relatively speaking, and that means that you probably want to hold on to some of that tech for those reasons. Not add necessarily, not buy the dip,
right,
but not run for the hills either.
And I have to say, God help us if Jensen Huang is cautious on Wednesday.
Yeah.
If he's not showing up in that leather snakeskin jacket and sounds a little bit worried, it'd be really interesting to see the trade.
Well, and we've got a lot coming up that's going to keep people nervous regardless of what he says on Wednesday. Between the possible government shutdown on March 14th, the tariffs on steel and aluminum that could come into effect on the 12th, you know, the next few weeks have some pretty major policy catalysts that could keep people a bit jittery about where we're going. And it gets back to the whole weekend, the bad performance on Fridays. You now have an administration that's going on X, Twitter, whatever you want to call it, 24/7.
Midday Friday,
right?
in particular.
And so you have to be managing your risk, knowing that you could have a shock you have to respond to Monday morning.
All right, Rebecca, it's fascinating stuff and kind of a bummer, really. Thank God we didn't get to the new bat virus. Rebecca Patterson there from the CFR, former Bridgewater chief investment strategist. We are looking forward, obviously, to those NVIDIA earnings on Wednesday, and tune into Bloomberg for that. We'll be laser focused on what goes on with tech when Jensen Huang dons the faux snakeskin jacket. Coming up, Apple plans a $500 billion investment in the U.S., but had it already planned that and it's just telling the president now for a carve-out on tariffs? Microsoft, on the other hand, is pulling back on data center leases ahead of those NVIDIA earnings. We're going to talk tech every day through Wednesday and beyond. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Jefferies upgrading Nike to a buy, saying that the sportswear company is positioned for a strong recovery over the next 2 years, and also that the CEO has the right playbook. Shares higher by about 5.5%. Next up, Bank of America downgrading Rivian to a sell. The firm citing a softer outlook for the EV maker this year and notes that risks are piling up. And finally, we have Alibaba getting raised to a buy over at Morgan Stanley. You can see the shares are sliding, though, down more than 8% after it said that it expects to spend $53 billion, Matt Miller, over the next 3 years on cloud tech and on AI infrastructure.
Wow, that's only a tenth of what Apple wants to spend over the next 5 years. Big tech firms are adding, and it looks like maybe also pulling back on AI plans. So there's up arrows and down arrows. Apple saying it's going to spend $500 billion in the U.S. over the next 4 years to build out its domestic infrastructure. That's U.S. only. Meanwhile, Alibaba is going to put $53 billion toward its own AI agenda. But TD Cowen says Microsoft is scaling back on data center leases. Specifically, TD Cowen says Microsoft has canceled leases for a couple of 100 megawatts of data center capacity. Bloomberg Technology co-host Caroline Hyde joins us now. If this is true, it's a pretty concerning report, and they're saying it's all because OpenAI, in which Microsoft obviously owns a very substantial chunk, is going with others like Oracle to build out its compute.
Looking at the Stargate deal in particular, Bloomberg Intelligence has already weighed in and saying regarding this chatter, they just think this is a reallocation rather than any change strategically. Microsoft has come back and said, we remain committed to spending $80 billion. So whether you believe they're going to be reallocating it in terms of building their own or whether it's going to be more leases, are they going to be doing it internationally? Are they going to be doing it more in the United States?
But they didn't say they have not canceled leases for a couple hundred megawatts of additional compute.
But what many analysts are saying is this is ultimately just the way in which you do business. A lot of these leases,
so they may have canceled those leases.
They might have reorientated, changed up whether these are long-term plans, whether or not you're indeed re-signing them in different places, whether or not it's sort of hadn't ever been a signed on the deal lease, but is something that they had agreed to in statement. I mean, Satya Nadella had talked about leasing additional capacity in 27, 28. BI saying, look, this is just about a reorientation of renting versus building. They think it's a good long-term sign for the company's capital spending direction.
I mean, isn't it just crazy to call it a lease if the deal isn't signed? I just think back to a conversation.
Well, who knows if that's the case? I mean, that's speculation,
well,
right?
Here,
you're speculating on.
No, I'm not. I'll give you an example. After the DeepSeek moment, I talked to John Gray about this. What happens to those leases if you're worried about CapEx spend? Any big company will tell you that these could be 10, 15, 20-year leases. They cannot possibly be that easy to get out of, right, Caroline?
I think it's ultimately what Meta used to do as well. It's sometimes that you have a measure of understanding that you're going to be doing a lease, but it hasn't actually been something that you've had to purposely agree to actually taking the money out. So I think this is something you see big tech companies do a lot of in terms of reorientating whether they agree to sign up to certain data centers or indeed not. And for me, the key takeaway is the company is still spending $80 billion.
Right.
How they're spending it, where they're spending it is what you want to be discerning. But what the real letter of the law is going to come in is when we see NVIDIA's numbers in the week. And ultimately, are people pulling back from AI investment? Many feel that NVIDIA is still going to be on track for 70% increase in revenue, a 63% terms in earnings per share. And since DeepSeek, they're still saying said nothing has changed in terms of the old overwhelming demand for AI compute. So I think now that's where we're going to get a little bit more of the tea leaves. We'll wait for a clearer statement coming from Microsoft, but I think ultimately they're trying to say this is the way we do business. Jordan Klein over at Mizuho saying this just seems like business as normal when it comes to Microsoft and what TD Cowen is currently trying to read into the chopping and changing of leases.
Right, and we'll stress again, of course, this is according to a TD Cowen report, so we'll wait.
The shares are down, though, so I guess that's something to know.
They are. No, it's certainly making a dent, and I think that just speaks to all of the lingering existential questions about AI spend right now. Caroline, before we let you go, I do want to ask about Apple, because Mark Gurman out with a really interesting story today that Apple said that it will hire 20,000 workers, also produce more AI servers in the U.S. I'll ask the question that Matt Miller has been asking all morning. Had they already planned to do this?
What's the devil in the detail is it looks like it's about 1,000 extra hires per year, and it's about $39 billion extra spending per year. That's not a massive ramp up, but it is a kind of ticking higher. And once again, Tim Cook is sort of makes an art of how you disclose these sorts of things. Remember, he did it back in 2018 when suddenly, oh, look at what we're doing in terms of our investment of making Mac Pros here in the US. Well, they'd already been making Mac Pros in the US since 2013. It's the way in which you dress it. So yes, they are doubling down on Houston. They're going to be making servers there. But remember, the chips that go in the servers are still being made in Taiwan. They're going to be making other chips here with TSMC, of course, in Arizona.
Certainly it does matter to the cities. I'm looking at Detroit for you, Matt Miller, home of the audio industry. See if that will be a bigger home for Apple moving forward. Bloomberg's Caroline Hyde, we thank you so very much. Coming up, more on real estate. Apollo is continuing its expansion with a $1.5 billion all-stock deal of Bridge. We're going to take a look at the latest acquisition in Wall Street Beat. This is Bloomberg. And it's time now for the Wall Street Beat. Today, we're looking at Apollo's deal to buy Bridge Investment Group for about $1.5 billion in an all-stock deal. For more, we're joined by Bloomberg's Neil Callanan. You are seeing Apollo effectively double its real estate business. What's interesting to me is not just the spate of acquisitions Apollo has been going on to grow, but the areas. It zags right when the others zig left. You think about real estate, so many are entering data centers. Apollo is going into the business of homes.
Yeah, absolutely. This is an interesting one because, the feeling for the last 2-3 years was that real estate was a bad place to be, but definitely there's been a mood shift. There's a feeling that there's going to be a great opportunity this year, particularly around multifamily that needs repositioning, i.e. people who had paid too much a few years ago. Now there's an opportunity to restructure that debt through a new credit provider. So that's one big area of opportunity. Another one then is around this 24% of all office loans in the US mature this year. In total, there's $1 trillion of commercial real estate loans maturing this year. And the Bridge is big on transitional positioning. So there's going to be a lot of money to be made converting offices into either more modern offices or things like homes or data centers potentially, depending on where they are.
Well, Neil, tell us a little bit more about Bridge Investments, because this deal values shares at about $11.50 per share. They closed below $8 a share on Friday, so a big premium there. Why does Bridge Investments specifically fit into Apollo's ambitions here?
Yeah, Bridge has about $50 billion of assets under management, so quite sizable for a commercial real estate provider. And they are in areas where Apollo isn't used. So they're quite good at giving loans lower down the market. Apollo has come in and largely done big deals, sometimes as much as $10 billion loans. These Bridge is much smaller and does smaller loans around the country. So it gives Apollo that regional focus. And if you want to launch funds, particularly through the wealth channel, you've got to get a diversity of loans. So for smaller funds, mainly aimed at retail investors, these kind of loans are more suitable for that. So it's another way for Apollo to tap the wealth channel. It's also a good source of loans for Athene, Apollo's insurer, which has kind of a relentless appetite for credit investments.
All right, Neil, thanks very much. Neil Callanan talking to us about the Apollo deal for Bridges. Meanwhile, we have seen the S&P 500 turn to losses, so continuing the fall that we saw on Friday.
Those dip buyers, a distant thought right now, really erasing those pre-market gains, which were pretty hefty.
Coming up in the next hour, Stephen Yalof joins us of Tanger Outlets on the state of the U.S. consumer, a big part of the sell-off on Friday. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
Coming up, stocks are struggling after the worst slide this year. Investors are trying to shake off tariff fatigue, and they're bracing for Nvidia's pivotal earnings and key inflation data later this week.
Elon Musk's job threat sparks confusion and divides the Trump administration. Several federal agencies are telling staff to ignore Musk's demand to justify their jobs, at least for now.
Meanwhile, this week, President Trump meets with France's Macron and the UK's Starmer to discuss the war in Ukraine. We'll set the stage with Brown University's Wendy Schiller. All of that and more coming up. Let's take a check at where these markets are trading, and that enthusiasm that we saw before the bell has faded and then some. The S&P 500 now down about 0.2% following that big slide that we saw on Friday. An even more exacerbated story when you take a look at big tech, with the Nasdaq 100 now down by 0.5%. This index fell by 2% on Friday. It looked like investors wanted to buy the dip in the pre-market, but that enthusiasm, that sentiment has quickly shifted now with losses deepening. And then the bond market, we've been talking about this drop that we've seen for 6 weeks when it comes to the 10-year Treasury yield, maybe finally acting once again as a haven, and maybe once again acting as that haven today, with 10-year yields now down about 1 basis point. Matt Miller, not a huge move, but take a look at the direction of travel.
Well, there haven't been huge moves, right? I mean, right before President Trump came into office, I think we were at 475 or thereabouts, firmly in the danger zone at the time, right? That was then for sure the danger zone.
And we lifted out a new danger zone with the 5%. I have to ask if 4% is another danger zone, because if we get there, is it signaling negative appetite, negative risk sentiment out there?
Well, I have the perfect person for us to ask that question on set right now. Joining us is Joyce Huang, American Century Investments Vice President, Senior Client Portfolio Manager. What is driving these yields lower? I mean, it hasn't been a massive drop, but 6 weeks in a row is a streak the likes of which we haven't seen since 2019.
Yes, so can that trend continue? And our belief is that this economy is likely headed for a bit of a slowdown. We are not saying recession, but I think when you're starting to see the data come out, you can see definite trends hinting at a slowing U.S. economy. We were growing at above trend for the last few years, and now I think it's time you're going to see that pull back.
Where is that not baked into the market? Because realistically, you're still seeing spreads quite tight across the bond market. Even in riskier debt, you're still seeing the 10-year at close to 4.5%, still around 4.4%. What does it mean if we start to see deterioration? Even if yields fall, are you going to see parts of the system that start to break?
Yes, so that is one of our biggest concerns, and it's a quandary for bond investors right now, because absolute yields are pretty high. You have to go back to prior to the global financial crisis to get yields that we've seen today. However, as you pointed out, spreads on both investment grade and high yield corporates are close to all-time tights. We're only 20 basis points really away on high yield from right before 08. So as we were talking about earlier, a lot of these things that we're seeing in the fixed income market are at data points that precede pretty bad happenings in the market.
Right, yeah, and those corporate spreads, a lot of folks have pointed to that and said, if you're looking for complacency, it's right here in the bond markets. I want to talk about the Treasury market a little bit more, because it feels like we're in a really interesting spot when it comes to the dynamic between the short end and the long end. At the short end, the Fed, I mean, it feels like they're kind of stuck on the sidelines. They can't do much with all these inflation concerns that are out there. And the long ends may be coming down, of course, as we think about that weakness that we might see in the economy. That yield curve steepener has been breaking hearts for years now. It seems like we're going to have to wait a little longer now in 2025, too.
Yes, so that's one area where we do see some potential opportunities is in the shorter end of the curve. I think, even though we said our base case is certainly not recession, the short end of the curve is really pricing that 1 or maybe 2 base rate cuts by the Fed this year. So if we actually do get more of a slowdown if we get a little bit more cooling in inflation driven by a drop-off in some of that very hot consumer spending that we've seen, maybe that could leave the door open to additional Fed cuts, which the short end really isn't pricing in. On the long end, the 10-year, we think it's a little range-bound. It's dropped over the more recent few weeks, but of course, there remain the deficit concerns. This summer, we'll have another negotiation of the debt ceiling and the budget and all that. And so I think with the clarity around Trump's policies and tariffs looming, that is going to really lead to some maybe upward pressure on the 10-year.
I also want to point out that as we're speaking, the S&P 500, not only is it down on the day, it's fallen below 6,000. We waited for weeks to get back up there.
I've been waiting for years to get there, right? I mean, 6,000 is still incredibly high for the S&P. That's still 10 times what we were at the end of the great financial crisis. But I take your point. It's a very big round number. Speaking of those, I wonder what your take is on issuance, because, you know, a different Huang, Anna Huang from Bloomberg Intelligence, wrote a great piece that Sonali pointed out last week on Scott Bessen's 3-3-3 plan. It looks really difficult to get the deficit down there, considering the fact that interest payments alone are going to be 3% of GDP over the next 10 years. But how much debt are we going to have to sell at these higher rates? As you say, levels on the 10-year higher than we saw since before 2008. We're refinancing like near zero debt into this more expensive stuff.
Yes, of course. So that is another problem that could put a little bit of pressure on longer-term yields, right? I think there's a lot of question about the Mar-a-Lago Accord, like what's going on there, the plans.
Do you buy into any of that?
I think we'll have to see. I think it's a little too soon to tell.
It's
but
fun to talk about.
It's fun to speculate, but I see why Scott Bessent is so focused on that, right? Because to your point, you know, the debt payments coming due and the refinancing, yields probably are not going back to pre-COVID levels. At least we should hope not, right? Because that means we probably have bigger worries to be thinking about.
Speaking of going-ons in Washington, you know, we are really just a couple of weeks left from that March 14th date. How are you thinking about potential volatility heading into that date when there are greater and greater worries about a potential government shutdown, about how the government plans to expand the debt ceiling?
So we have run across this several times in the last few years, and there's always a deal done at the last minute. Given that the Republicans do have control of the presidency and both houses of Congress, we're not too concerned about an actual shutdown happening. But of course, volatility should pick up as we get closer to that date, leaving active managers some opportunities to pick up some basis points, hopefully.
All right, Joyce, great having you here. Fun to talk fixed income for a moment. Joyce Huang there from American Century Investments. We want to turn back to equities because we are looking at an increased sell-off on the S&P 500 with the index falling to session lows, the NASDAQ 100 index falling to session lows, looking at almost, well, 0.6% on the S&P 500, but getting the NASDAQ 100 falling 1%.
Yeah, it's really big tech that is leading this sell-off. You take a look at the biggest movers. We have Microsoft, Palantir, NVIDIA. On a points basis, those are your biggest losers. Interesting, Microsoft. I mean, we were talking about how this report, it's from a TD Cowen note, so it has to be verified. Microsoft, of course, pushing back that it's canceling data center leases.
Not pushing back too hard. They didn't say we're not canceling data center leases, because that would be.
They did say, though, that their AI spending plans are unchanged. I hear what you're saying, but the stock is moving nonetheless. Microsoft down about 2%. That's taking a big chunk out of the index. Palantir down 11%. Exactly. That's after falling 15% last week. So this sell-off really showing that it has legs.
I'm also looking at gainers, and to Matt's point here, it is defensive, defensive, defensive. Healthcare is really the only major sector that is in the green so far today on the S&P 500. Real estate to follow it, but of course that's on the heels of lower rates. And again, we've been talking about it, the lower rates. If it's because you're looking for a haven bid, is that a good thing? I don't know that you can hold on to that sector if you see parts of the economy slowing down.
We do see, in terms of the breadth, we still see a pretty even split, right? 260 stocks are up
Right.
240 stocks are down. And the biggest gainers in terms of points, Apple, obviously one of the biggest stocks on the index, but it's up 1%, so it's adding almost 5 points. Berkshire Hathaway, which we've been talking about, doing well in terms of its earnings over the weekend. Berkshire Hathaway up 3.6%, so they're adding almost 4 points to the S&P. And then you had Procter & Gamble, also one of the bigger gainers. That's the defensive play, right? This is the stuff that you absolutely have to buy even if you get fired. And I think that's the concern right now.
Market's certainly playing defense. And with Apple, I'd like to tell you, Matt, that kissing the ring would help you out in this market.
It helped them last time.
It helped them last time, but it is not helping out Tesla. It is the worst performer in the Mag 7 so far this year. We're going to turn now to positioning. We're going to go to see what's happening in Goldman's prime brokerage desk, which says that hedge funds aggressively unwound risk in technology stocks once again. Here's Bloomberg's Janasiewicz with more.
Hi, Sonali, and we do see that degrossing was one of the largest in the past 5 years, and it was very similar when we look at the two-week time frame, very similar to what we saw in July, right before that late summer sell-off. However, it doesn't look like hedge funds are completely bearish on this group. So this chart from Goldman's prime brokerage desk shows that there is a rotation going on. The yellow line shows net exposure to TMT group. Yes, it was a decline in exposure. However, we see that it's still moving higher, which is also the case because we saw some rotation into software stocks. But when it comes to Magnificent Seven stocks specifically, this is a different story. This is a blue line. We see that exposure keeps moving lower, and now it's hovering somewhere at around low levels that we saw in April 2023. So some kind of bearish sentiment is developing.
Yeah, an interesting rotation going on there when it comes to the tech names. Take us to the options market, though. What are we seeing in terms of positioning there?
Yeah, so it's a big week with NVIDIA earnings. And of course, we looked at QQQ positioning, at NVIDIA positioning. We don't see a huge demand for put options. Implied volatility for NVIDIA specifically suggests that the stock can move slightly above 7% after earnings. And this is below levels we saw during the past earnings season. So we don't see any anxiety. However, on the macro level, we see a little bit different story. So this chart shows net interest of call options versus put options for the VIX index. We know that the VIX itself sits at a very low level still. However, those latest headlines, specifically macro headlines, inflation, tariffs, geopolitics, prompted many traders to position for more potential upside in the VIX index. So this ratio right now sits at the highest level in 17 months. So guys, we do see some anxiety around VIX trading.
I am fascinated by the VIX here. Over at 19, fair enough. The people who are pointing out that it is still below the long-term average, yeah, that's absolutely true, but it is still well above the one-year average. And I think that matters because you saw some volatility spikes through the course of last year. Relative calm, 19 over 15 is significant.
All right, let me thank Natalia Janasiewicz there for her presentation. And I think very interesting that it looks like hedge funds have lowered their exposure to the Mag 7, but they're still boosting their exposure to the broader tech sector. Of course, everybody's on edge today after the big sell-off on Friday. Looks like it's continuing.
Yeah.
Although, you know, we're only down 0.25%. It's a red arrow on the S&P 500.
On the S&P 500?
Yes.
Yeah.
On the broader index. I know
Well,
you're watching the big tech-heavy NASDAQ, but even the NASDAQ 100 is now only down 2/3.
Actually, I have a stat for you exactly on this. This, of course, coming from Jess Menton and Alex Semenova on our equities desk.
Of course.
The S&P 500 has gone 35 sessions without posting consecutive declines of more than 1%. So if we get past that 1% barrier when it comes to the S&P 500 in terms of downside, we'll be looking at some interesting size and scopes. And again, it matters in terms of that dip buying impulse that this market has relied on for years.
The bummer is that there's nowhere to hide. Gold was down Friday. It's down again today. Bitcoin is clearly not a place to go hiding.
I think that people are looking for protection.
The bond market. At these yields, I guess it's a place to lock in.
If you've been hiding in Bitcoin for the past 4 or 5 years, you're doing damn well.
There are certain some of them.
I don't know
look,
if they're hiding there.
We have been hearing from so many people that we're due a correction. We're due the pause that refreshes. We're due a 5 or 10% sell-off. We can't go there if we don't have double days of
You can't go up if you don't go down first.
Declines. Coming up, Elon Musk. Have you heard of him? He's given federal workers an ultimatum, but some other people in Trump's administration are pushing back on the super billionaire. We'll bring you the latest out of D.C. next. This is Bloomberg. Let's get now to high interest. Look what's making headlines around the world. In Europe, Germans headed to the polls yesterday. The CDU won the most votes, but coalition talks remain before a government is formed. Party leader Friedrich Merz has called for a quick solution as Germany faces challenges, obviously at home as well as abroad. Merz has also been vocal in calling out Elon Musk for supporting the AfD. They came in second place. And he's called for Germany and Europe to become independent of Trump's America. Meanwhile, the Trump administration is taking aim at China as tensions mount between the two economic superpowers. In recent days, President Trump rolled out a memo telling a key government committee, CFIUS, to curb Chinese spending on tech, energy, and other strategic American sectors. The administration is also calling on Mexican officials to place their own levies on Chinese imports. The U.S. is proposing fees on commercial ships made in China in order to counter the nation's maritime dominance. And don't forget, they did enact an additional 10% of tariffs on China February 4th. Meanwhile, scientists at China's Wuhan Institute of Virology recently reported the discovery of another bat-borne coronavirus. The novel virus is capable of entering cells using the same human receptor that played a critical role in the devastating spread of COVID-19. Although there have been no reported human infections thus far, the news boosted shares of vaccine makers, underscoring global concerns about the ongoing threat of animal diseases capable of sparking deadly outbreaks, especially if they're the very same thing from the very same place, Katie.
Yeah, it's a bit troubling. 5 years later from the OG. We'll continue to keep an eye on that story. But let's switch back to the U.S. because several government agencies are advising their employees to ignore a demand from Elon Musk's Government Efficiency Office to justify their jobs. Musk set a deadline for today and said, quote, failure to respond will be taken as a resignation. Joining us now from Washington is Bloomberg's Tyler Kendall. So, Tyler, those are the marching orders from Musk, but we know that at least the Pentagon and the Department of Justice have told their workers to pause on replying. So what is the latest state of play here?
Right, Katie, conflicting information for federal workers. What this indicates to us is that none of these agencies were given advance notice before this memo went out. So we're going to have to see if we get more from the White House when it comes to whether or not they want to see ultimately these agencies to do this review. But big questions still remain about the legal basis that Elon Musk has in his capacity as a special advisor to President Trump to enact widespread federal terminations. But he does appear to have the mandate, considering that this memo went out over the weekend, just hours after President Trump said that he wanted to see DOJ get more aggressive. But when we were talking about the next steps here, particularly when it comes to a legal fight, we are expecting multiple cases to be filed, including the largest union representing federal workers has already said that they would contest any firings that come about as a result of this. And remember, it really could be widespread. Only about 20% of the nation's federal workforce is local here in Washington, D.C. and the surrounding areas. And often we talk about President Trump trying to shake up Washington institutions, but this really could have a more wider spread impact across the country.
One question I have is not the pushback that they're getting more largely, but actually the pushback, Tyler, they're getting between Trump's own aides and advisors. Amid the group that even sees DOJ as a potentially good thing for the government, what is the pushback that they're getting?
Right, exactly, Sonali. And we're actually really seeing this mainly from some national security adjacent agencies. I think the DOD, the State Department, also the FBI, now run by Kash Patel, considered to be a pretty staunch supporter of President Trump and also a critic of the FBI itself. So likely he would like to see some of these changes. But we're going to have to see kind of how that dynamic of power with Elon Musk as an aide to President Trump. Now, I would also point out, reporting on the Terminal New this morning from Bloomberg News, that some allies, including OMB Director Russ Voigt, who's now also the acting head of the CFPB, indicates that he might be concerned that Elon Musk is moving too quickly here, and that ultimately that could open him up to legal scrutiny, which down the line could mean that these agencies end up standing as they are. We should say that a spokesperson denies that report, but it does show us what has become mounting tensions within this administration. And also, just important to note, a little more widespread, most of what federal workers do also impacts other employers. Think about how many federal workers give out when it comes to spending and funding that could go to states or other agencies around the country. So there really are multiple players out here that could be impacted.
All right, Tyler Kendall, great reporting as always. I'm sure we'll be checking in with you again very soon. That is Bloomberg's Tyler Kendall joining us from Washington. Up ahead, much more markets coverage. You can see the S&P 500 off session lows, but still down on the day. We'll discuss next. This is Bloomberg. All right, welcome back to Open Interest. We're taking a look at markets right now at about an hour into a pretty rocky session, following a rocky session that we saw on Friday. The S&P 500 now down less than 0.2%. We are well off session lows, but even still, you take a look at the NASDAQ 100, that follow through, that fear that we saw on Friday, still at play in the NASDAQ 100, off about 0.6%. The bond market catching a bid. People are looking for safety right now. They're finding it in the bond market, down about 2 basis points on your 10-year Treasury yield. Let's take a look at the sector level because it's an interesting split there. Pretty much even if you take a look at what's gaining and what's not. Up at the top, you have healthcare, currently higher by about 0.8%. At the bottom, you have infotech, you have consumer discretionary, pretty much what you would expect to see. And as we were talking about where to find safety, people are finding it in the likes of healthcare, in financials, and real estate today.
Yeah, I mean, if you look at, if you take that chart and change it to a 5-day, then you'll see it's healthcare, consumer staples, utilities. Thank you very much, Joe. So very defensive sectors leading the way. I will say, though, that the breadth is getting better. Right now, 309 stocks are up, and only 194 stocks are down on the S&P 500.
And while everyone was sleeping, I think what's also interesting is the expectations, too. Speaking of the bond market as a haven bid, part of this is because of changing expectations. You have a basis point, you have one rate cut now baked in to July.
All right, when we come back, we'll speak with Stephen Yalof about the consumer. He's the CEO of Tanger. This is Bloomberg.
Let's talk about Tanger. The operator of upscale open-air shopping centers ended 2024 with strong results that saw gains across several metrics. For more on how the U.S. consumer is feeling these days, I'm pleased to say that we're joined again by Stephen Yalof. He is the CEO of Tanger. Great to see you again.
Thanks for having me back.
I want to start with the share performance because I was playing with some charts this morning. So Tanger shares up 260% on a 5-year total return basis. You compare that to the S&P 500, up a pedestrian 100%. It's really
only doubled.
It's remarkable outperformance in your stock price. What's the next 5 years like? How do you keep this momentum going?
Well, first of all, let's say that I think it's the entire retail segment that is really performing.
You're outperforming the regional mall index quite handily as well.
Well, you know, we like to be humble.
Okay.
But, you know, for us, I think what's happened is the consumer has totally changed since COVID. So that's almost 5 years ago, right? Mm-hmm. So if you take a look at how the consumer's shopping right now, they're looking for far more than just stores to go buy things. When they get off the couch and get into the environment, they want a great experience too. And I think, you know, if we're going to differentiate ourselves from other developers of shopping centers, I think we're very focused as a team on delivering that experience.
One thing that could kind of throw the wrench into this performance of the retail sector, as you're talking about, and certainly the mall sector, is what you're seeing from consumers as well, right? That University of Michigan data showing you that the longer-term inflation expectations have risen quite meaningfully. How do you prepare for that from your seat?
Well, I think it's the diversity of offering that we bring into the shopping center. So it goes back to my original, comment, is that, it's more than just going to stores. It's about better restaurants. It's about a movie theater. It's about better entertainment. It's about amenities. And, we've also, over the last few years, we've introduced loyalty, which for us, Tanger as a brand We have 40 Tanger shopping centers across the country. You can use your loyalty at any one of our Tanger shopping centers. So it's nice to be rewarded for your patronage when you come and visit us.
We are watching the labor market very closely, and it's fantastic still, right? I mean, unemployment is 4% even. But we're starting to see more and more stories about firings, more and more concern among in the consumer confidence surveys about losing a job. Are you seeing that reflected at all in the consumer that comes to Tanger outlets?
Well, first of all, when there's macroeconomic headwinds or when folks are faced with, economic uncertainty, I think what the first place they're going to seek the products that they're looking for is in a value channel. And so we're fortunate that we're in that space and we get to offer value pricing every day. Now, our consumer is looking for the things they love: Kate Spade, Michael Kors, Coach, Ralph Lauren, Nike. They want great brand, but we get to offer that to them at value pricing every day. And I think that they reward us with their patronage through that connection.
Let's talk a little bit more about your portfolio, not just of brands, but also your physical footprint, because just in the last few weeks, you announced the purchase of Pinecrest, that is open air, grocery anchored, mixed use center in Cleveland, Ohio. When you take a look at your pipeline, are you looking to build it out? Or are you happy with where you have spaces right now?
No, I think we want to grow. We've built this great operating team. We operate, we market probably better than any of our peer group. And, we have a great leasing team, too. So between those three disciplines, we think we can leverage that existing portfolio of business and grow our footprint. We added those 2 centers in the last 3 months. What's unique about those centers is they're not outlet centers. They're full-price retail centers. But we think over the past few years, we've gotten very good at diversifying our portfolio, diversifying the uses and adding more variety. Food, entertainment, restaurants, things like that. So it plays really to our strength when we go after this different category of business.
I want to switch gears a little bit, talk not about the consumer, but about your cost of financing. You take a look here at the 10-year yield, and it's been down through the course of the year. What, 6 straight weeks we've been saying? And does that get you excited? Do you start to look at that and say it's more permanent, we're seeing lower costs of financing, we're ready to dive into real estate, maybe buy some assets from some competitors, maybe look at some M&A? How does that impact you?
Well, that's exactly how we're looking at it. Our investment relations team and our markets group have been very active in the business. We've written over $1 billion worth of assets, I would say, in the last 6 months, 12 months. So we're actively looking in the marketplace. To us, what makes the most amount of sense is a shopping center. We're not only buying yield, but we're buying our opportunity to grow that yield over time. And so that, getting back to my, the operations, marketing, and leasing, if we can add value to a shopping center, that's something that we're interested in pursuing. As far as our, cost of capital is concerned, we just announced that we were able to sell some shares into the market and raise some equity that way. Also, the capital markets, we don't have any significant debt maturities for another year and a half. So our balance sheet is in really good shape. We're 5 times debt to EBITDA, which is pretty low for our asset class. That gives us the strength and the opportunity to go out and really execute, hit the balance sheet, and start buying some product. But again, product that makes sense.
Stephen, your business is very American, right? But you talked to me about these big brands: Kate Spade, Michael Kors, Ralph Lauren, Nike. What else did you say? None of those companies make anything in America, right? That's all made in China. That's all made in Malaysia. That's all made in Singapore. That's all made in Vietnam. Are you worried about tariffs? Because surely if we get 25% tariffs on those goods, they're going to be passed straight through to your consumers.
Right. We've spent a lot of time, we're out with our retailers all the time. And we've got, I mentioned my leasing team. I can't say enough unbelievable things about that group. But what makes them so special is the relationships that they have with the retailers across our portfolio. And so, that's, when the tariff conversation, going back into October and September, when the first conversation about tariffs was in the news, we did have those conversations with them. And I think a lot of retailers, particularly out of COVID, when things got blocked in China because of the China COVID laws, supply chain getting locked up the way it was, I think a lot of the retailers that we do business with diversified where they did their manufacturing. And I think that that's really what they're leaning into now. There's plenty of manufacturing still happening overseas and in Asia, but there's a lot of there's a lot of manufacturing that's taking place in places like South America too. Right. So I think the ability to diversify where products are being manufactured have given a lot of our retailers the confidence that they'll be able to fill the stores and, you know, keep on providing products to the consumers.
Well, Stephen, we only have about a minute left, but I am curious, when you're evaluating your portfolio of brands and you're going through your decision tree, does the trade picture impact your decision to add or delete a brand at all, or what does that decision process actually look like? Well,
you know, again, in the outlet space, when a brand thinks about growing their portfolio or contracting their portfolio, you know, the last stores they close are the stores in the outlets. You know, it's that's where they're going to clear their inventory, even if they're winding down. So we find that a lot of brands really look at that part of our business as a really important part of their ecosystem. And so, and the other thing I'll add to that is simply, you know, going back to the conversations that we've had with retailers, is that there's not a lot of retailers that are looking to change their open to buys. They still are actively pursuing stores in the bricks and mortar space. They like the interaction that they have with the customer. You know, that younger customer, Gen Alpha, believe it or not, there's a Gen Alpha now. Yeah, 5 to 15. Well, that customer likes to shop in stores, believe it or not. You know, they love the health and beauty space. So Sephora, Ulta, that's where we're finding a lot of our youngest customers. That's what they're coming to enjoy when they come and shop with us. And, you know, we're hoping that we're creating a whole new generation of bricks and mortar, open air shopping center shopper.
To wear makeup growing up.
I have hopes for that generation.
Yeah, I think your kids are Gen Alpha.
Not
so that
quite
makes
yet,
sense.
because they're 4 and 1. So.
No, I think they're Gen Alpha. The next generation is Gen Beta.
Oh, I thought they were 5 to 15, but maybe that includes mine.
No,
we'll see.
Anyway, Stephen, it's great to see you as always. Really fascinating look at the consumer and also how retail companies are feeling right now. That is Stephen Yalof of Tanger. Meanwhile, quick check on these markets right now. We're not on session lows. We've come back a little bit, but still down firmly for the day. The S&P 500 down about 3 to 0.4%. Big tech leading losses, with the Nasdaq 100 down about 0.9% on pretty hefty trading volume. Meanwhile, that bid is building in the bond market, with 10-year Treasury yields now lower by about 2 to 3 basis points. Sonali.
Absolutely incredible. A perfect 4.4%. We're going to get a look at the stocks moving under the hood this hour with Bloomberg's Bailey Lipschultz. Bailey, NVIDIA now firmly in the red for the year.
Trading lower, Sonali, all ahead of results on Wednesday. Right now, looking at the terminal, more than a 7% move priced in according to options in the aftermath of the results. As you guys mentioned, Katie, you said down 0.4%. Well, we're really following big tech trading lower. So as you mentioned, NVIDIA down 1.7%. Looking at the screen, biggest laggards in terms of points: Microsoft, NVIDIA, Meta, Broadcom, Amazon, Tesla. But to the upside is Apple. Apple trading higher. A number of headlines coming from these companies. Microsoft peeling back some of their spending in data centers. That, according to TD Cowen analysts, and obviously Apple laying out plans to join the spending parade. The one thing that's been interesting this year, though, guys, is the fact that Apple really has been trading kind of divided from the rest of the Magnificent Seven, whether or not that's seen as a fact that the company was late to the AI party, now joining the AI party. But it does seem like when we see the broader group selling off, Apple's outperforming, and vice versa if we get headlines that people are really piling back into spending, you know, hundreds of billions of dollars on these infrastructure bets.
Are you, would you, if you wanted a pizza, would you order it from Domino's?
So, Matt, my parents' condo in Oceanside, California is above a Domino's, and the smells on that balcony
are fantastic.
Impeccable. Like, I can't tell you how good the pizza is when I'm in California, and I know that we're in New York City, pizza capital, however you want to view it, but I'm not going to lie, Domino's pizza is heavily undervalued, at least in terms of the flavor profile.
I'm in the minority here because I
love Domino's.
No, I can't.
Apparently, though, people in the U.S. tend to agree with Matt, Bailey, because you take a look at what they reported in their latest earnings report, and it seems like international was strong, but can't say the same about the U.S.
Yeah, same-store sales climbing 0.4%, missing the average expectation of what analysts were looking for. As you mentioned, the stock under a bit of pressure, trading at the lowest level earlier this morning since late January, but at one point when it was down closer to 7%, that was the biggest drop intraday since July 2024. So weakening demand in the U.S. We're certainly going to keep an eye on on what these consumer companies are reporting. Again, we had kind of whether you wanted to stand on the bearish or bullish case in the wake of Walmart's results. A lot of these companies' consumer earnings season is upon us, and it does seem like Domino's, at least at this moment, is missing expectations.
Bailey, I'm getting pretty bummed out. Give me something in the green today.
Trading higher, Apollo expanding into real estate, $1.5 billion bet on Bridge. I had to do a little bit of research into this company, a small cap, but this is a company that operates in the kind of wealthier space in terms of real estate, beating expectations, as you mentioned, up more than 35%, but going to put a little bit of a kind of perspective. If you look at it on a trailing 2-year average, Bridge only returning even after today's rally, minus 13%, lagging the Russell 2000, which has returned 17%. So trading at the highest level since November after that merger deal. It is all stock, but as I'm sure you appreciate in terms of some of these deals, it does seem like the likes of Apollo and others really betting that the bottom is in on real estate, and that's showing up at least in this news today.
All right, Bailey Lipschultz, great roundup as always. With all the news, that's Bloomberg's Bailey Lipschultz. And it's interesting, I asked the magic answer machine what Generation Alpha actually is. So apparently it refers to people born between 2010 and 2025. So your kids are safely in Gen Alpha. Unfortunately, while Gen Alpha is an awesome name, people born between 2025 and 2039 are going to be Generation Beta.
I think they're going to want to change that.
Yeah, I don't know where that came from, but
nobody wants to be a beta.
Yeah, maybe we can work on that.
Yeah, but apparently Generation Alpha, I looked it up as well, and Google Intelligence says they are brand loyal, more brand loyal than Gen Z. So to Stephen's point, good shoppers.
There you go.
Coming up, European leaders are heading to Washington to try and secure a role in Ukraine peace talks. Good luck with that. We'll speak with Wendy Schiller from Brown University next. This is Bloomberg.
To achieve peace, if you really need me to give up my post, I'm ready. I can trade it for NATO membership if there are such conditions. I am focused on Ukraine's security today, not in 20 years. I am not going to be in power for decades.
That's Ukraine's President Zelensky speaking through a translator at a news conference yesterday. Those comments coming after President Trump called him, of course, a dictator and started walking back support for the country 3 years into its war with Russia. Meanwhile, French President Emmanuel Macron meets with Trump today in Washington to discuss the peace process. Joining us for more is Wendy Schiller, director of the Taubman Center for American Politics and Policy at Brown University. And Wendy, one of the things that continues to strike me, I see headlines over and over again that first Trump blamed the war on Zelensky, and now Trump and Hegseth are trying to keep the accusations that Russia started this war out of various resolutions. And why does it seem like there's so much on the side of Vladimir Putin? Is that now okay with his base? Is the Trump base sort of pro-Russia?
Well, I don't know if they're pro-Russia, but Trump basically looks at everything like a deal. What deal can I cut? What victory can I walk away with? And I think in his mind or in his view, he doesn't see making Putin the all-out enemy as a winner. That Putin doesn't give up, that Putin has lost hundreds of thousands of Russian soldiers in Ukraine and just won't go away. So how do you translate that into a deal for the United States that Trump can claim credit for? So that's where I think Trump is in his thinking. I'm not sure he's loyal to anybody. He could be sort of currying favor with Putin today and Xi Jinping tomorrow. I mean, he just wants the deal that makes him look like he can do something that Biden couldn't, which is to end this conflict in a way that preserves some or most of Ukraine and gets Russia out of an active war situation.
Wendy, I'd love to kind of weave in the cross current of the German elections as well. As Germany looks to assemble a new government, and it could take some time for all the pieces to come together, how does that impact the relationship between what is happening in the United States, Europe, and the war in Ukraine?
Well, Germany has been a stalwart for so long against the rise of essentially really right-wing, fascist tendencies. We see this all breaking out all over Europe, but Germany has usually held fast and steady. And certainly in the international community, in the NATO community, that's been a bulwark, and the relationship is quite strong between the United States and Germany. But if the far right does take enough of a hold that Germany tilts, then I think there's much greater concern for holding the line against authoritarian dictatorship, and the line of criticism against Trump internally, I think, will grow louder. And not just among Democrats. Republicans are very uneasy about this sort of like love for Putin that they're seeing. They're uneasy about walking away from Ukraine entirely. And they're uneasy about cultivating a right wing that may not be controllable. And so I think seeing what happens in Germany and how Trump treats that affects Europe, affects a military situation, but also ultimately economic relations. So there's even more instability to come if Germany starts to crack.
You know, we love to talk about the Mar-a-Lago Accords, which is wonky, very Bloombergian, sort of the idea about a debt transfer of treasuries for longer dated bonds. But it all starts with the idea that the cost of global defense isn't equitably spread out. And Trump has been pushing this narrative since his first Munich defense conference, although he sent Pence then, and now he's not a Pence fan. This time he sent J.D. Vance. Do you think this is a victory for Donald Trump? You know, he has really shifted the payment of global defense more towards Europe, and it looks like it's set to go even further. They're set to take up even more of the cost of NATO, and maybe even put their own troops in harm's way instead of ours. Is that a victory for the president?
I think it would be a victory for Donald Trump, and of course an isolationist tendency across the board that we're seeing. Certainly the first steps in terms of trimming government, shutting down USAID, like ripping the sign off the building. This is a real concrete return to the voters that elected Donald Trump, who said, take care of us first, and then if we have anything left over, we can help the rest of the world. So we're seeing this in international health care. We're seeing this in international weapons, arms, money. So that is a victory for Trump. The problem for Trump and this wing of the Republican Party is that the United States is globally, economically so intertwined, not only with Europe, but with the rest of the world, that a healthier, safer, more stable world is better for the U.S. economy. And if the world starts to crumble and become less safe and more chaotic and less healthy and less able to work, earn money, and consume U.S. products, our economy will get hit. And I think that's the balancing act that I haven't seen any preparation for as of yet from the Trump administration.
Certainly a lot of question over how much payments could be cut down over at the Pentagon, as well as the broader budget. Wendy Schiller of Brown University, we thank you so very much for your time this Monday morning. And stay tuned for live coverage of Trump and Macron's joint news conference. That is at 2 p.m. New York time. This is Bloomberg.
Welcome back to Open Interest to check on these markets right now as that sell-off continues. The S&P 500 down about 0.4%. The Nasdaq 100 really leading the declines in big tech right now, with the likes of Microsoft and Palantir lower mightily on the day, currently down by about 1% on the big tech benchmark. And then you can see that bid is really building in the bond market, with investors reaching for safety right now. I think it's particularly telling that you have the S&P 500 currently below 6,000. You also have the 10-year Treasury yield below 4.4% as well.
Yeah, absolutely. Fascinating to watch that continued drop in the 10-year yield. But the question is, why are investors buying those bonds? And if they're buying bonds because they're worried about the U.S. economy, it makes sense that they would also be selling off these equity indexes.
Yeah, I think that that's an interesting part of this, isn't it? Because to the point that we were making earlier, maybe a month ago, is that you would have wanted to see the 10-year fall because of constraints on fiscal pressures, right? For other reasons. But now we're at a different point of the story where people are starting to get very worried about growth.
Yeah, absolutely. That sort of textbook relationship coming back, which maybe is comforting to some, that the long end, the Fed can't really control it. It's really based on the economy. You have economic growth fears coming in, but at least bonds are acting as your haven, because you think back to 2022, the S&P 500 falling, and bonds didn't do anything.
And if rates continue to come down, it just makes it all that much easier for me to finance my Harley.
And that, really gives me comfort at night.
Did you know that I'm going to Austin right now?
I'm so excited for you.
Enjoy
I won't
yourself.
be here for the next couple of days.
Come back with a hog.
I'm going to ride motorcycles in Texas. Tomorrow on Open Interest, Barbara Ann Bernard of Windcrest Capital joins us, as well as Nancy Tanger of Laffer Tangler.